What's up, everybody? Tuesday, July 13th. Inflation alert! Inflation alert! Yeah, we had a big CPI number today. CPI for June came in at 0.9% when the forecasts were 0.5%. I actually saw the word hashtag inflation trending on Twitter today, so everybody was talking about this. Bond yields popped up a little bit, bond prices down, stocks sold off. If you look at that report, which I did in the BLS.gov release, the main culprit in there was car and truck prices, used car and truck prices. I think they're up like 10.5%. You also had the energy component in there, which was up, but even when they stripped out food and energy, it was up pretty substantial. So, inflation fears are back big time. I'm not gonna downplay this number. I didn't expect it to be that high, but I will say that in spite of this, we have not seen really any sharp increases in wages. Remember, that's really important. As a matter of fact, I spoke about this last week with the job number when I said the June job number, if you look at average hourly earnings, that increased by the smallest amount in 3 months, okay? And it was the second month down. So again, I think this is transitory. I mean, if you go back to March, think back to March, at that time, everybody was pointing to like lumber prices and commodity prices. Lumber has given back its entire gains for 2021. As a matter of fact, it might be down year over year. Some other commodities too are down, soybeans, I believe. So we are seeing in some areas, what were formerly concerns, like price concerns, they're starting to abate, they're starting to dissipate, all right? And I remember back in March, there were many confident, like really confident predictions of a 2% yield on the 10-year Treasury, back then, because the same thing, there was a lot of inflation hysteria going on. And I said, whoa, you got to pump the brakes on that, for a number of reasons. But at the time I was saying, number one, the Fed was saying it's not going to raise interest rates. That's the main thing. And number two, we were facing the prospect of a gigantic historic increase in bank reserves with the Treasury spending down its account at the Fed and the Fed continuing to buy $120 billion a month in securities. And, that happened. And I mean, when you have this massive addition of cash to the banking system, that just drives rates down. I mean, banks compete to lend that overnight, for a little bit of profit, and that just pushes rates down to the point where the Fed had to, step in and start doing these reverse repos to drain out some of that cash because it was having an effect on their policy rate. Which, brings me to the point now, what's the outlook for interest rates? Well, again, I mean, there's two factors going on here. One is a policy factor, and that's the most important thing. Like, what is the Fed going to do? And right now, the Fed is saying it's sticking with its current policy and its current rate, although, in the last Fed meeting, they were saying, or at least that dot plot, whatever they use there, was saying now they're looking at the first increase in 2022. And I think there are members in the FOMC who would like to raise rates sooner rather than later, but they haven't stated it like that. So for now, I'm saying policy remains the same, and that's at least neutral to bullish on bonds. The other thing is that second, technical factor again, that with one thing added this month. We're still going to have reserve build because Treasury is still reducing its balance, its account at the Fed. Fed is still buying $120 billion a month in assets, so that's adding to reserves. So you're still having this huge increase in reserves, which is going to keep the lid on interest rates. But the new element in the picture is the debt ceiling. And that has to be raised by the end of this month. Now, if that's not raised, the result could be an acute shortage of Treasury collateral. And you might say, well, Mike, what's the big deal? So you have a shortage of Treasury collateral. So big deal. Well, it is a big deal because Treasury securities are the most widely held financial instrument in the world. And it's not because, hey, people love those things and they like to hold, they like to buy them and hold them. No, it's because most financial institutions throughout the world are required to hold a certain amount of U.S. Treasury securities. They're the highest rated tier 1, asset collateral, and they're literally the grease that, keeps the financial system working. So if we get into a debt ceiling situation where it's not raised and there's no more issuance, the financial system will be competing, entities within the financial system will be competing, bidding up that collateral, at least I think. And that's going to push yields down, bond yields down. So that's a major, major thing that's coming up. To me, it looks like, at least politically, I don't think there's a good chance that we're going to see an increase in the debt ceiling. We might, but right now with the Senate 50-50 and the Republicans, not wanting to really cooperate with the Democrats or vice versa, I think the prospect of a debt ceiling increase is pretty low. So you have these three technical factors. You have the Fed continue to buy $120 billion a month. You got Treasury drawing down its account at the Fed. And you got the debt ceiling coming up. And I could even throw in a fourth factor, is that if the stock market is rolling over and starting to correct here, and again, I'll point to the fiscal flows. I just sent out a chart to my subscribers. The fiscal flows slowing down. And you know me, to me, that is the basis of all conditions looking forward. Those flows drive everything. With those flows slowing down and the stock market maybe now going into a correction, you could see a movement back into bonds. So for me personally, I see this blip up in Treasury yields as not sustainable. I also think the inflation hysteria, the inflation concern, that's going to abate. We're seeing it in some elements of the picture that were like the leading elements a few months back. They're no longer that. You're really talking about automobile prices. And I just saw a couple of reports saying that used car prices have already peaked. So that's basically where we are on this picture right now. Again, you want to go against hysteria. You want to go against people who don't understand, like we had a rise in the dollar today. Buying a currency because there's rising inflation, that just doesn't hold, okay? If that were the case, like countries like Argentina and Turkey would have the strongest currencies in the world. And countries like Japan would have the weakest currencies in the world. It doesn't work that way. Now, I understand that kind of zombie reaction and that reflex reaction. But, if you're going to make any money long term, you have to go against ignorance. You have to go against lack of understanding. That's a clear sign. When you see something like that, it doesn't mean like in the short term it can't keep moving a little bit because, you get that knee-jerk reaction and people jump in and they say, oh, high inflation in the United States, Fed is going to raise interest rates. If high interest rates were bullish for a currency, again, you'd have Turkey and Argentina and Ukraine with the highest, with strongest currencies in the world. It just doesn't work like that. Just doesn't work like that. Come on. So that's where we are. I did a podcast today. It'll be uploaded tomorrow. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye.